Healthcare is arguably one of the most defensive sectors anywhere around the world, and people can delay buying a house, buying a car, but you cannot delay your heart surgery or your oncology cancer treatment. So, in Malaysia, healthcare wealth is actually built along two main tracks. The first one is healthcare providers like hospitals, and the other one is healthcare manufacturing like glove manufacturing or generic pharmaceutical products. So today in this video, we're going to cover chapter 8 of my book, The Malaysian Multibaggers, which is a deeper dive into the healthcare sector within Malaysia. We'll explore how local companies turn hygiene, healing, wellness into 10, 20, 30, even 40 times shareholder returns. And we look at the moat that they can sustain growing the business into the future. Hello everyone and welcome back to my channel. My name is John, former engineer turned full-time investor, currently wealth planning director at Phillip Capital, as well as the author of this book called The Malaysian Multibaggers, which showcase to you how Malaysian companies actually return 10, 20, even 100 times shareholder returns to all its shareholders. So the first sector that we will dive in the healthcare industry is actually the hospital services or hospital providers, in which their business model is really providing inpatient or outpatient treatment to patients. Malaysia practices a dual-tier healthcare system where there is a free, almost free public healthcare, but it's often congested and there's long wait times. And this drives a lot of the middle class and above to actually private healthcare where wait times are shorter and you get specialist attention at a much faster rate than the public healthcare system. So the magic metrics for a hospital provider is the profitability on two things. One is the occupancy rate. That means how much you can occupy your hospital beds, like how airlines actually look at utilization of their aircraft. If it's like 85-90% utilization, that means you can fill the aircraft and you can make money. And the second thing is actually the average revenue per occupied bed. That means if one patient comes in and he has 10 procedures instead of one, and the revenue by having 10 procedures is much higher than that of a competing peer hospital, that's where this particular hospital has an edge, for the lack of a better word. So what is the moat? High barriers to entry is actually one of the biggest moats, because to build a hospital is on average, it takes between 2 to 4 million the cost of building one bed. So this averages out your operating theatre, your pathological lab, your your clinical centres, your diagnostic machines and all that kind of thing. So on average, if a hospital has 100 beds, that's anywhere between 2 to 4 million per bed, and you just multiply by the number of beds they have, and you will average out all their other ancillary facilities. Second mode is really very intense regulation. You don't just simply open up a hospital by just registering a company. You have this thing called a Kebenaran Merancang from Malaysia, will be Kementerian Kesihatan or the Malaysian Ministry of Health. And the third mode is really how do you create an ecosystem or environment where you recruit the top specialist doctors to want to come and serve you, because they will bring along the reputation, the trust, and the relationship that they already have with the existing clients and even new clients. Because all these three combined, it creates a very high or very big, very high barriers to entry. And not many small players can actually come and fight against the incumbents. So let's look at the two largest players in the hospital provider space within Malaysia. One is actually a premium global player, IHH Healthcare Group, and it was actually born from a mega merger by our sovereign wealth fund, Khazanah. And their mode is really premium branding. They have the Gleneagles brand, they have the Prince Court, they have the Pantai hospitals, which really attract high value medical tourists, and a lot of top tier specialists actually serve within the IHH group of hospitals as well. The metric that is benchmarked against the other players are actually the average revenue per occupied bed day, or ARPOBD. They on average have a 20% higher ARPOBD, average revenue per occupied bed, that is 20% higher than its local peers. And it's really affecting or displaying is sheer pricing power that is much higher than the local player competitor, which is KPJ. But KPJ, on the other hand, their mode is really a laser focus on second-tier cities. They actually, the CEO, the current and the previous CEO has stated this very clearly. They are not here to fight in the first-tier cities like Kuala Lumpur, Penang. They have, but their focus is really second-tier cities where people like IHH would not really want to go in. And they want to provide a little bit more affordable, local, Malaysian-centric kind of healthcare, rather than risk like a very risky global expansion, in which IHH has done, and some of the hospitals did not really work out, right? So the secret weapon, ironically, is being an asset-light model where they charge out all their hospital assets into a REIT called ARCA REIT, and the REIT will actually lease back the hospitals to the KPJ group. So the KPJ group is purely focused on the operations of running the hospital rather than be burdened with saddled with debt of balance sheet to finance all these hospital assets. So that makes them a little bit more leaner, makes them a little bit more light on that, or more asset light, for the lack of a better word, and it frees up massive cash that they can use to expand the hospitals, especially in second tier, third tier, where you may have a longer gestation period because of purchasing power, volume of patients you're going to see, as compared to the IHH guys who are like in smack in KL. They are almost, some of them, very close to each other, like Gleneagles and Prince Court is literally like a few kilometers apart, right? But yet, because of the high density concentration of population within KL, they can survive. So between IHH and KPJ, in terms of shareholder return, IHH ironically has not been as impressive, and KPJ has returned a staggering 38 times since the early 2000s until today. So over 20 years, 38 times, I don't think anyone will be complaining. So there you go, the focus on the sector of healthcare providers or hospitals within the wider sector of healthcare. So the next industry I want to cover within the healthcare sector is actually healthcare manufacturing, and in particular the glove industry. So the disposable glove industry was really built based on pandemic crisis rather than being built gradually. And what really drove Malaysia to be one of the largest disposable glove exporter in terms of volume was the HIV and AIDS pandemic in the 1980s, which made gloves mandatory for healthcare workers. The SARS pandemic forced the shift from natural latex, powdered latex, natural rubber gloves towards nitrile, and this business is really around a very high volume commodity kind of product. So what do I mean? The revenue is simply the volume that you can sell, multiply against the average selling price, and they don't sell by piece, they sell by 1,000 pieces. So it's like, let's say it's $25 per box of 1,000 pieces. So that's how you actually calculate revenue. Obviously, when the COVID pandemic actually hit, price surged 500%. Volumes also surged because there was just so much demand and very little supply. And everyone started building mega factories, including China, which was never known to be a big supplier. And today, the entire industry has undergone a structural change. Malaysia, Thailand used to be big players, and now China has just increased supply by many, many folds. And this actually led to a brutal oversupply scenario where it came down really, really fast. Average selling price came down, volume actually came down. And I think Top Glove, being one of the largest players, actually had a huge drop in market cap as well. So looking at the sheer scale and size, today Malaysia is still one of the largest, but they can't claim that throne with pride, because China has now been propelled up to be at the top of the supply chain as well. And in the past, Top Glove being the largest producer by scale, they make about 100 billion gloves per year at the peak. Now they are facing increasing challenges in terms of ESG, labor issue compliance, and they were actually banned at one point of time by the US Customs and Border Patrol in 2020 due to them not meeting certain labor and ESG requirements. the innovator within this crowd, and also the second largest by volume, Hartalega, they have always been at the forefront of technology. They were the first to produce the lightest weight nitrile gloves. They were also the pioneers in making very, very fast lines. I think 45,000 to 55,000 pieces produced per hour. And during the same time, Top Glove was doing what, 25, 30,000 pieces per hour. And they, Hartalega, I mean, has a very pristine, labor issue record. They've never been found to be in non-compliance. They treat their workers really well, hostels, really well. So I guess right now, if you look at the glove industry, if you want to invest in it long term, you may want to think very hard about the structural changes that has happened during COVID. And now, if you want to capture more margins, it's still back to the US markets rather than Chinese manufacturers, because what the game that the Chinese manufacturers play, because it's all about compliance, it's all about certification, it's all about playing the quality game rather than price to the bottom. So yeah, that's my thought process about the glove manufacturing industry. What they used to be champions, now with structural changes, we really need to think hard again how these players will position themselves to scale or grow in the future. The next sector, I would deem them the everyday heroes. We take them for granted, is actually the generic drug manufacturers within Malaysia. Now, we do not have any original drug manufacturers, the guys like GlaxoSmithKline, the guys like Pfizer, the guys like Johnson & Johnson. I don't think we have that kind of R&D budget, and you don't want to fight these giants. These are incumbents that have been around for many, many years. But where Malaysia really excel is actually providing affordable pharmaceutical products for the Malaysian market. And these are your everyday heroes where, IHH Healthcare have been providing this thing called cough syrup, Bena expectorant. I had it as a child. I think most Malaysians can relate to the brand, Xepa, right? They have also began the expansion because they realized that within Malaysia, the addressable market was just so small. They've expanded into 24 countries. They run a very massive wholesale distribution network, and they use this as a hedge against local slumps, local demand slumps. Over the past 20 years, they've delivered roughly 12 times shareholder returns. And the second peer to them, they are also within not just the generic drugs, but they also built out a supplement business. I'm pretty sure most Malaysians would have seen their brand in big chain pharmas like Caring or Guardian. This brand called Appeton. You have the Appeton weight gain for older folks that want to build up their body mass if they are like picky eaters or they're having health issues that they can't eat properly. So it's almost like a complete diet. And then you've got the vitamin C's that that you give the kids, and a lot of colorful flavor. My kids eat them as well. So where their moat really comes from is having that branding that first top of mind, shelf space within and affordability. Most important, affordability also within the pharmaceutical supply chain. And I think it's become a household name that in the past when it first started out, I would not doubt that it had been difficult to build the brand, but today with over 10, 15 years or even 20 years of history, I think that trust has already been embedded with a lot of Malaysian families. Now, I think the struggle for them is really how do you scale outside of Malaysia? How do you build that brand, replicate the playbook of distribution outside of Malaysia? So there you go, the sector of pharmaceutical manufacturing and distribution. So whether it's an asset-light hospital, an ultra-fast glove manufacturing line, or a trusted generic cough syrup or supplement, healthcare wealth is really built on what I call durable moats. It's like regardless of whether there's a recession, whether inflation is high, I think healthcare is almost like an evergreen, sustainable kind of industry, almost recession-proof, because it's an everyday necessity. You need to get well. So how would you value these different kinds of business model? You cannot apply one template for, even though they're in healthcare, but manufacturing versus hospital providers. You need to understand each sub industry or industry business model, unit economics. And I think going through the pandemic was scary for everyone, but it also proved about how resilient these business models are. And you can find a quiet multi-bagger. I mean, like a lot of people pass by a KPJ hospital, sometimes on their way to work, and never realize it can be a 38 multi-bagger. So if you want more insights about what are the things to look out for, a template for understanding the industry, grab a copy of my book, Malaysian Multibaggers. It's in stores in Popular and PH. It's also on Shopee. You can get the link, just link in the description below. And I think this is one of the industries within Malaysia that we can stand proud of, being one of the largest glove manufacturers within the world. And we have almost world-class healthcare within our Malaysian shores too. So let me know what you think. Let me know you think whether this is really a resilient industry like what I mentioned, or do you think it is reached a saturation point where there's not much hope of scaling and growing. Looking forward to seeing you in the next video.